All right, so welcome again. My name is Greg Klein from Hayes Financial Group. Our topic is investing strategies. We'll see here in a second the agenda for the material that we have prepared. And don't be concerned, it's not, you don't have to be a seasoned investor. This is high level investing stuff that we're going to talk about. So we'll set our baseline. We'll talk about asset classes. If you've been on any presentations with me before, we've touched on this, but we want to make sure and set that baseline so we know what we're talking about, because understanding these asset classes is key to the other segments of the presentation, like these pitfalls that we want to avoid, some best practices, some of the simple solutions. And so first up is our asset classes. Those are those different types of investments that you have available in your 401k, 403b. And broadly speaking, there are like 4 different asset classes that all plans will have available in them. Stocks or equities is a big one. And if you're investing for a far off goal like retirement, that's going to make up a majority of the assets that you have in your account, because historically speaking, they've offered the greatest amount of growth. You want to grow your money for retirement, you're probably investing for a far off goal. So it's okay to accept that additional risk that stocks have. And then stocks, they call them equities because your ownership, you're buying a little piece of a company. And in your 401k, 403b, you're going to buy into dozens or hundreds of different companies. So stocks, that'll make up a big chunk of your portfolio. Bonds are another piece that will make up a portion of your portfolio. They're going to be lower risk. So bonds compared to stocks, bonds are not ownership. Bonds are actually where you're acting as the lender. So if you have a bond, what you're doing is you're lending your money to either a corporation, or if it's a federal bond, like the federal government, and that bond is an IOU, and so you lend them your money. They pay you interest over a period of time. When that bond matures at the end, then they give you your money back. And so that's what it makes them lower risk compared to a stock, because with a stock, there's no guarantee that you're going to get your money back at the end. It depends on how that company performs that you own a little piece of. Where bonds, there's that promise that at the end, you're going to get your money back when the bond matures. Then from stocks, you can branch out outside of the United States to international stocks. That's an important part of your portfolio. And also on the lower risk side, like bonds, cash equivalents will be an important part of your portfolio. A minor part of a retirement portfolio, but an important part nonetheless. So you have these different asset classes, and the mix of investments, or the percentage that you have in each of these different asset classes, is what they call asset allocation. And that's going to be key to some of the segments that we go through in the moments ahead. And then understanding also that risk reward trade-off with these different asset classes. A lower risk type of investment, like a cash equivalent, historically has offered a lower rate of return. If you take additional risk, like in bonds, or further yet in stocks, you're typically paid for that risk. There will be more movement with that type of investment, but you'll get paid for that additional risk. And so this idea of asset allocation and this risk reward trade-off are something that I just wanted to go over once again, so we all understand that clearly as we move ahead into some of the more investing focused material. And I'm kind of acting as a young parent. Young parents, they're always going to tell their toddlers, no, 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 you can't do this. So that we're going to kind of start in that fashion and say, avoid these pitfalls. Don't do this is what we're going to look at first, like the emotional investing, chasing returns, stopping your savings. And that first one is emotional investing. And I put on this slide also overly emotional investing, because I don't believe that you can detach your emotions completely, especially when you're saving for your retirement. This is maybe a dream of yours that you've had for as long as you can remember. So obviously there's going to be some emotion involved with the savings, with this investing that you're doing. But what we don't want is our emotions to take control and cause us to make decisions that could hurt us over the long run. You see this wheel on the slide, and it just shows you that our emotions move along with the market. When the market's high, our emotions are high. We might get overconfident, be too aggressive with our investments. that's when we're tempted to buy into those maybe more aggressive investments that we would typically, or be more aggressive with our allocation than we would typically. As we go, clockwise and go down towards 6 o'clock, down towards the market bottom, that's when we aren't so confident. Maybe we're a little bit afraid. And unfortunately, that's where a lot of average investors will sell. So what they do is they buy in when they feel good at the top at 12 o'clock and sell out at 6 o'clock when they're not feeling so good. And what are they doing by doing that? They're essentially buying high, selling low, buying high, selling low. And doing this over time can hurt them with the performance of their portfolio. So we want to avoid overly emotional investing. And that's what we'll get to with some of our tips, our best practices, because the market, no matter what, it's always moving. So we're going to have those periods of time where the market moves. It's going to move frequently, these movements of 5%. You'll see multiple movements like that in a single year, 10% or more, at least every year. That's called a market correction, where you see that sort of movement every year. 15 to 20% you're going to see every handful of years. So understand the market's always moving. So if that wears on your emotions, we need to prepare for that. We need to do something to make you so that you're confident with your plan, so that you can ride through those ups and downs in the market and benefit from that extra return that you get by having money exposed to the stock market. Because my rule of thumb is like, on the plus side, you might get twice as much as on the negative side. So let's say, if you want those years where you're going to make 20% a year, those good years where you make good money, you see good returns in your 401k, 403b. Well, if you want to see those years where you're up 20%, there's also going to be years where it's down 10%. That's kind of how the market has worked historically. So there's no way to see those years where you're up 20% all the time and not have those years where it might be down 10%. So using those numbers, that's like, let's say $100,000 401k, 403b balance. Well, if you want those years where it's up really well, you see your 100,000 turns into 120,000. Well, you might also have those years where 100,000 then all of a sudden looks like 90,000, and you got to be able to roll with those ups and downs, because they happen frequently. If you look at just over roughly the last decade, you'll see quite a few bumps in the road. There's been quite a few times where the market's been down 10, 15, 20%. Just think of last year around this time, where the market was down 30% or so. And that one, that's a big one. The most recent one is the one that we always remember that hurts the most. It was pretty quick that the market fell, and then pretty quick that it came back. But again, these are pretty normal. Those big bumps in the road, like we saw, they're going to happen every handful of years. And so you got to understand that, so that you don't let your emotions get the best of you. One thing that you can do is understand, if you check your account frequently, you're likely to see losses more than if you don't check it quite so often. That's kind of intuitive, but if you're checking your account on a daily basis, if you know that you're tempted, or maybe in the past you have made these changes based on emotion, and then a few months or a year later you were kind of kicking yourself, why did I do that? Why didn't I just stick to my plan? Maybe not check your account so much, because if you check it all the time, the market moves every day, so you're more likely to see those negative numbers. If you wait and just, check it maybe when you get your statement once a year, if you have a strategy that you're confident with and you have a plan, it's okay. You don't have to be checking your account all the time. And then you're less likely to see those negative numbers that might influence you to exit the market. Because if you exit and sell your investments, in those at those low points when your emotions are low, and then you don't get back in and you miss some of those good days that oftentimes happen very close to the bad days, you can see with this slide how missing just a handful of those good days in the market can dramatically hurt your performance. Take a $10,000 investment over this 20-year period, that 10,000 turned into 40 plus thousand, but missing only 10 of the best days, that performance was cut by more than half. The 10,000 only grew to 19,000, and you don't have to go very far. Missing 30 of the best days, and all of a sudden it's negative, where the person was actually losing money over this 20-year period versus gaining. And those best days, like I said, they happen a lot of times close together with the best and the worst days. Just a year ago in 2020, the second worst day of the year was March 12th, and that followed immediately on the 13th by the best day of the year. So if somebody had seen that the 12th was a really bad day and they were thinking, I can't take it anymore, this market's just been going down, I'm going to sell and get out and I'll wait to get back in. Well, then they missed a huge day the following day. And you can see missing just a few of those good days can really kill your returns. So we don't want you to be too emotional with your investing. Don't follow the herd. So many people do this with their money. We want to avoid this with you. If you need a second opinion, reach out before you make any big decision with your money, especially when times are tough, because we see performance again over roughly 20 years. The stock market performance is the best. You blend in those lower risk investments in like a 60-40 portfolio, or even a majority lower risk stuff in a 40-60 portfolio, but you can still see the returns are okay year after year. In over this 20-year period, they all beat out the rising cost of living with inflation. But if you look at what an average investor did, the retail investor, you see how they move money into and out of the market. They barely beat out the rising cost of living. So their money barely grew for them in real terms because they barely beat out the rising cost of living. They did far worse than what some of those portfolios or like 100% stock portfolio did. And that's because of moving money in and out of the market at the wrong time. Because if we follow our emotions too much, that's what we're tempted to do. The other pitfall that we want you to avoid is chasing returns. Don't just look at what's performing best and invest in the hot performer. It's understandable that you want to do that. Who can blame you for wanting to invest in the winner? I mean, everybody wants to make money, everybody wants to invest in the winner, but a lot of people will look at performance of funds in their plan, and they'll look at this and see fund C's done the best, that's where I'm going to put my money. And we'll see a few times in the presentation why that is focusing too much on the short term, and that can hurt you. You want to have a long-term plan for retirement. Don't just chase the hot performer, because something that's performing well this quarter or this month doesn't mean it's going to be performing well into next year or the years beyond. Everything cycles. So if it's a good performer now, it might not be next year. It might take a few years for it to cycle back and be a top performer again. And that's illustrated by this colorful chart. This shows you 10 years of performance. Best performing area is across the top, in the top row, the worst performing area across the bottom in the bottom row. And you can track any of these colored squares and get an idea of how things are doing. If you look at, I'll put my cursor over 2019, 2020. You can see this area was a top performer and then is down. And for 2021, at least year to date so far, is not negative, but not one of the top performers. So if you enrolled in your 401k, 403b, maybe later on in 2020, and you saw, well, this area has been doing well, I want to chase the hot performer, I want to be investing in a winner. You put your money there. Well, then so far in 2021, you might be disappointed with your returns. So we never know when this is going to cycle. You'll see it's never the same area across the top all the time. It's not the same area across the bottom necessarily all the time either. If you diversify and spread your money out, that follows more of those yellow boxes, and you see those yellow boxes hover more around the middle. The highs won't be so high, lows won't be so low, but that's key to long-term performance with your 401k, 403b. So we want you to avoid those pitfalls like too much emotion, chasing the hot performer, because that's always going to be changing. Instead, we want you to follow best practices like diversification, rebalancing, dollar cost averaging, that we'll get into here in the next few slides. Diversification is, as we just saw on a slide ago with those yellow boxes, how, yeah, you might not make a killing. You might not be the top performer every year, but you're not going to get killed either. You're kind of being that happy middle ground where it will help you sleep better at night. And you do that by spreading your money out, that idea of diversification, not having all your eggs in one basket, using those different asset classes that are available in your 401k, 403b, and utilizing those, having money in different areas like stocks, bonds, cash, and international. And that's going to help you because those different investments, as we've seen a few times, have different rates of return. If we look at just the 1 year periods of a stock portfolio, a bond portfolio, or a mix, 50-50, we see that stocks have some pretty good years, but they have some pretty terrible years as well. Bonds are lower risk, so there's not as much negative movement there. And then 50-50 portfolio. But for any 1 year, you're gonna see some movement, even in a diversified portfolio. Understanding how your time horizon, how much time you have until you're gonna need to withdraw this money, it ties into this idea of diversification or spreading your money out. Because the longer you have, with diversification, like in that orange, the orange bar, the 50-50 portfolio, you can see with just a handful of years, even any 5 year period, then you're avoiding that negative territory. The longer out you go, then you see that range tightens, like with 10-year and 20-year periods. But diversification, you see with going out to the 20-year period, if you're investing for a far off goal like retirement, if you're diversified, you're not giving up a lot in terms of gains to not have to worry about having, a multiple year period, 2, 3, 5 years, where you end up in negative territory. By mixing in lower risk investments along with your stock market investments, you can benefit from the gains in the market. You might not make a killing, but you're not going to get killed, and you're not going to have the the um, the downside risk with that diversification. So spreading money out, but the stock market is up more than it is down historically. So it's okay to have that stock portion in your account. Don't be afraid of that money that's exposed to the stock market, because even though there are negative years, it's still up more than it is down. You can see that green line in this distribution chart, and anything to the right of that's a positive year. To the left is a negative year, and you can see there are many more positive years than negative. And even 2020, if I had asked you a year ago if you had thought 2020 was going to end up being a positive year, up double digits in the stock market in the US, you probably would have thought it was crazy, but that's how it ended up. I mean, the stock market is a weird beast. You never know when it's going to turn around. And so you have to roll with these ups and downs and understand that spreading your money out with diversification can help you with that. Because if we go back again and look at a period of time, going back to, even further back to the financial crisis, if you look back at that time in 2007 when it peaked and then it dropped down to 2009, you can see that 100% stock portfolio, that's that S&P 500, that green line, that it did drop the most. So then it took longer to recover. It took 3 years to recover, where those other portfolios that weren't 100% stocks, they had some lower risk bonds and cash, they recovered in under a year, or maybe just over a year, where the stock portfolio took about 3 years to recover. This time around in 2020, it did not take so long to recover. It was really quick down and quick back up. But this was the crisis before the pandemic. You saw in the financial crisis with the full stock portfolio, it took about a year, or excuse me, about 3 years for a full stock portfolio to come back. So that diversification, that helped them on the downside. They didn't go down quite so much. So then they had recovered quicker. And then you see it does take a while. The stock portfolio does eventually outpace the others again. But what does the average investor do in that time? They do a lot of worrying and maybe changes that will hurt them. They don't necessarily ride out those ups and downs appropriately. So mixing in other and lower risk investments with your stock allocation can help you with diversification. And then the second best practice is, once you're diversified and you have that mix of low and high risk investments, maintain that diversification with what they call rebalancing. Rebalancing is simply adjusting your account periodically to keep your allocation to the higher risk stuff in the stock market and the lower risk stuff in stocks and bonds where you want it to be. If you started maybe, maybe it was sometime in 2020, maybe even about a year ago. Let's say you started with a 40% allocation to lower risk bonds and cash. That's where you wanted to be, 40% lower risk. The other 60% you were okay exposed to the stock market. Now, the stock market over the last 12 months has performed pretty well. So your lower risk that was 40% before, now a year later, these are just hypothetical numbers, but it might be only 25% because the higher risk stuff in the stock market has outperformed. So it makes up a bigger and bigger percentage of your portfolio if you don't do any adjustments to your account. So where you wanted 40% low risk because that's your risk tolerance because of maybe your time horizon, you're getting closer to retirement. Well, if you don't do anything, if you don't rebalance that, now you're really at 25% low risk, not where you want to be. So you'd want to rebalance, bring things back into alignment with 40% lower risk back where you want to be. That helps you keep your risk level right where you want it to be. It can also help your performance over time. And we'll see that in just a moment. But when I talk about rebalancing, the next question often is, well, all right, I know I should rebalance. I understand rebalancing, but how often should I rebalance? Is it better to do it every month, every quarter, once a year? And honestly, if you look back over almost a century in the market and you have an account that was rebalanced every year, every 3 months, once a month, you can see that the performance does not change very much at all. And the volatility is almost the same. So the idea is just to do it. Don't worry about it. If you want to do it every quarter, that's fine. If you want to do it just once a year, that's fine. Even every couple of years, the idea is just to do it. This person that rebalances every month, I mean, that's a lot of work. If you're doing it on your own, you might be able to set it up on your 401k or 403b to be done automatically. If you like to do it every month, not a problem. Just do it. Do that rebalancing either on your own or set it up to be done automatically. Because if you don't, again, what happens is you get out of balance and then you'll find yourself in a situation where if the market's high, now you have more exposure to the stocks and to the market for when it shifts and when the market corrects or when the market falls. Like this chart, it shows this unbalanced account had a lot more in stocks than it had initially. It wanted 60% allocated to the stock market. But before the market corrected, then back in the financial crisis, you see they were up more at like 70% allocated to stocks. So then when the market did fall, they were hurt even worse. And then when the market was going to recover in that sort of green shaded area, well, then they weren't in as much into the stock market, so they weren't able to benefit as much from the recovery. So it works against you if you're not rebalancing because you'll end up being overweight in those stocks when you really don't want to be. And then when you do want to have a lot in the stock market, you'll be underweight. Rebalancing helps you keep things in line so that you're prepared for the good times and the bad. And you can see the result of that with quarterly rebalancing versus no rebalancing. And we saw it doesn't matter quarterly, twice a year, once a year, you just got to do it and it can help your performance. You can see this in this account with $100,000 balance, and we're talking about $5,000. I mean, that's real money just for flipping the switch and turning on that automatic rebalancing with your account. It can help you sleep better at night, knowing that your plan is steady, that you're going to stick with that allocation and it's going to adjust for you periodically, and then help you make a little bit more money over time versus an account that is not being rebalanced. So diversify, spread your money out in those different asset classes, rebalance it periodically, just do it. Doesn't necessarily matter how frequently you do it. And then keep that money going into your 401k or your 403b with what they call dollar cost averaging. That's putting in your same deposit. It's probably a percentage for you, but you're putting in that deposit all the time on a routine basis without thinking about it. From your paycheck, you're making that deposit And when you do that, that's called dollar cost averaging, because you'll make your deposit, and whatever the price of your investments are on that day that the deposit goes in from that pay period, that's the green bars on this chart. If those green bars are lower, that means the price is low. And that, as a result, makes that blue bar higher. And that means as prices are lower, you'll buy more shares. You're always making the same deposit and just buying whatever you can. If the price is low, you'll buy more. If the price is high, you'll buy less. And you adjust, and that actually helps your performance as well over time. So there's these really simple things that you can do with your 401k, 403b, like diversifying, doing your rebalancing, turning that on to be done automatically, and then keeping your money going in. Because if we go back to our emotions and think about what do our emotions tell us to do if the stock market is falling, they say don't throw good money off after bad. Don't put any more money into that. It's losing money. But ideally, you would keep that money going in, because if things are down, if you're continuing to make those purchases and make those deposits through your 401k or 403b, then you are going to be picking up more shares with those deposits, and that'll benefit you. Buying low, and that'll benefit you over time. So those three best practices, and they're simple solutions for doing that in any retirement account, 401k, 403b. There's simple solutions where you can tick a lot of these boxes, by just picking one type of investment. Because all these 401k, 403b plans will have something like either a target date fund, which is a fund that does all those best practices. They'll diversify. So they're going to spread your money out in one single investment. They'll put you into low, medium, high risk investments. So like the cash, bonds, stocks, and international stocks. They'll rebalance. So they're going to periodically bring that asset allocation into alignment by doing that rebalancing, because they're going to adjust that based on your time horizon. With a target date fund, how it works is the closer you get to your target date, which is your retirement year, they're going to adjust to get more conservative or less risky. In your 401k or 403b, you might have some risk-based portfolios as well. Those work the same way. It's just rather than a target date that you're selecting, you're picking your risk level, conservative, moderate, or aggressive. And those are going to be diversified. They're going to be rebalanced. You just have to make that adjustment over time. As you get closer to retirement, if you're an aggressive portfolio, you might want to think about shifting that to more moderate or conservative with those risk-based portfolios. But that's doing a lot of what we've discussed already in one simple step, using an asset allocation investment like a target date fund or a risk-based portfolio that's available in your account. If you are more hands-on and you like to do the diversification on your own, that's okay. Make it automatic. There are these switches that you can flip on in your account and set up your diversification, and then also click that button that says automatically rebalance my account. And we saw earlier, it doesn't make a big difference. Do it every quarter, twice a year, once a year, whatever works for you. Just turn on that auto rebalance. And if you want to see if you are more hands-on and you're doing your diversification, but you don't really know, do you have the right mix of stocks and then the lower risk stuff and the bonds and the cash? A simple rule of thumb that's used is you just take 110 minus your age. That gives you an idea of how much you should have allocated to the stock market. So take somebody that's 40 years old, 110 minus 40 gives us 70. That means, someone middle-aged, 40, they might have about 70% allocated to the stock market. And then now 30% roughly in the lower risk stuff like cash and bonds. The target date funds will do that for you. If you are a little bit more hands-on and you like to do that, make sure you are diversified, but then turn on that auto rebalancing. And then that last step, taking advantage of dollar cost averaging by keeping your contributions up, is as simple as just don't stop your 401k or 403b contributions unless you absolutely have to. Because even if things are bad and the market is down, I tell people focus on the fact that you're still acquiring shares. With every deposit you make, you're acquiring shares. And equate this to building your retirement house. So your retirement house that you're building, you're not going to buy it all at once. You're going to buy, square foot at a time until you eventually acquire this entire house by the time you retire. But what you're doing is you're acquiring square footage. Those are the shares that you buy when you make a deposit in your account. If when you go to make that deposit, the price is low, you're going to buy more square footage of the house. If the price is high, you'll buy less square footage, but you got to keep the deposits going in and just buy square footage with every deposit from every paycheck, because you're not. And what the price or the value is of that house at any moment in time is truly irrelevant, because you're not buying it all at once, and you're also not going to sell it all at once. When you get to retirement and you begin to live on that money and withdraw it as your income in retirement, you're going to do it little by little. You're going to sell the house off essentially, a square foot at a time. So people fixate so much on, what is my account worth today? And that truly isn't what we need to be focused on, because you didn't buy all of your retirement all at once. You're not going to sell it all at once. It's about acquiring it little by little over time, and then you're going to sell it off little by little over time. So remember, as long as you keep the contributions going into your account, you're always going to be acquiring shares. That's like acquiring that square footage in building your retirement home. So diversify, rebalance, keep the money going in, make it easier on yourself, use the easy to use investment options that are available in your plan, use things like auto rebalancing, keep the money going in, don't stop. If you reach or hit a rough patch and you need to stop or reduce your savings a little bit, I understand we all hit tough times in life, but try to keep that money going in all the time. Don't get scared by the market and stop those contributions, because you want to keep building your retirement house. And if you need help, it's always good to talk to someone. So call us, send me an email, use our scheduling resources you see at our website, or our Calendly link. Either of those websites down at the bottom will give you the option to schedule a consultation with us that doesn't cost anything. That's part of your 401k or 403b services that we offer to you. So don't hesitate to set up one of those. And then we'll continue these quarterly webinars. So we'll talk to you again in another 3 months. We got resources available at our website. We're always available by phone or online. So please reach out.